Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined, as per usual, by Ryan Sweet, director of real-time economics. Hey, Ryan, all is well?
Everything's well. Busy weekend, but everything's good.
Good. We just chatted on Friday, and I'll come back to this in a second. This is a little bit of an unusual podcast, but so we talked a couple days ago. So you had a good weekend.
I did.
Good.
Until I had to fill up at the pump. It's getting expensive.
Yeah,
What's your indicator?
We'll come back to that.
That's your indicator.
What'd you pay? $3.40, $3.50 for a gallon? Oh no, you get premium,
You
don't
gotta
you?
get the premium in these SUVs now, so I'm over $4.
Really? I didn't know that. Really, you have to get premium? I didn't know that.
Well, maybe not in your SUVs, but you should be.
Oh really? Huh. Okay. Cris, you get premium? Oh yeah, you're the first.
Oh, I do not.
You get the super octane plus.
No, Cris plugs his
No.
cars in.
Oh, does he?
Nope.
Oh, you don't?
I get the cheap stuff.
Mhm.
Oh, and that's Cris Dorides, deputy chief economist. Hey, Cris.
Hey, Mark.
And
Yeah.
you had a good weekend also.
I did. Yep. It was
I
a
wrote
little
a
on the
piece-
cool side, but
I know. Jeez, it's already winter here. I wrote a piece on inflation. So, apropos to the conversation today, because we're going to be talking about the history of inflation. This podcast is going to be different. This is going to air the week of Thanksgiving. So it's a little over a week from now. So this is more of a kind of an evergreen. We're not going to do the statistics today like we normally do. We're just going to dive right into the topic at hand and inflation. And this is really, we're going to take a step back first here and talk about the history of inflation. Inflation since the nation's founding. Hopefully learn some lessons from our experiences of inflation past, and then talk about inflation now, because obviously that hair on fire, kind of moment. Everyone's really upset about the 6% plus CPI inflation report we got last week, and so want to talk about that. So this is a little bit different. I will say, if you really do miss us week of Thanksgiving, you can always follow me on Twitter at Mark
I knew it was
Zandi.
coming.
So just an advertisement. I'll be tweeting for sure, during this period. So please feel free.
I just want to know who wins the volleyball.
Exactly. That's what.
Right. So that's why I'll be tuning in. So
Yeah,
better post it.
We're all gearing up for that. The volleyball. For folks that weren't listening a couple of podcasts ago, volleyball is what the Zandis do on Thanksgiving. We go into a racquetball court set up as a volleyball in a racquetball. I think it's racquetball court. Yeah. So it allows the old guys to play with the young guys, the women to play with the men. We can all kind of be equalized, so it's a lot of fun. So someone always gets injured. Hopefully it's not me, but someone always gets injured. But I'll let you know. Okay, let's dive in. So the way I was thinking about framing this conversation, or at least around the history, was I've identified half a dozen inflation eras, let's call them. And I'm hoping that we can talk a little bit about the era and then, what we learned about inflation and inflation dynamics from that experience. And very quickly, maybe I should just name the eras, see if you guys agree or disagree with this kind of breaking up of history. So era number one, pre-Federal Reserve. The Federal Reserve was put on the planet back in 1913. So anything from the beginning of the nation's founding, let's say, 1770s through early 1900s, that's the pre-Federal Reserve era. That's an inflation era. Second, the Depression of the 30s, that we saw deflation during that period. So that's a period unto itself. So that's the second era. Third era, World War II, Korean War. So that was the 40s through most of the 50s, at least the mid 50s. A lot of rationing and shortages, and talk a little bit about that. Then the fourth era is the period what I call Great Inflation. That was really actually began in the mid 60s, and then inflation steadily accelerated through the 70s, kind of peaked in the 80s, and it didn't really kind of normalize until late 80s, early 1990s. So that's the fourth period. The fifth period I call the Great Moderation. That's the 1990s and through 2010. That was a positive supply shock, the tech boom and the impact that on inflation. And then, of course, the low inflation period after the financial crisis, That's the most recent period, and then now here. That's 6 different eras, and then now here today we're in the middle of the pandemic, and we're starting to see inflation again, and we'll talk about that as well. So, what do you think? That's a generally pretty good way of thinking about the history of inflation in the context of the United States? Does that make sense to you guys?
It
Anything you would
does.
add?
It's a lot, right?
Yeah.
But I think that's the right. Those certainly are all the major eras. So we may spend more time on some versus others.
Yeah.
Yeah. There's one period I could not kind of fit into the frame. That was between 1955 and 1965. It's like not influenced by wars. The Korean War kind of ended by then. But there was, inflation was kind of moderate during that period. So that's the 10-year period that I didn't put anywhere. So I'm not sure what to do with that one. But
So this is like a walk down memory lane of your professional career as an economist.
exactly.
Yep.
Yeah. It's so funny because just per chance, I picked up a book on Andrew Jackson. I was reading a little bit about the second Bank of the United States, and this gets to the first period pre-Federal Reserve. And you guys want to take a crack at characterizing that period? I mean, I got a sense of things, but do you want to characterize that period in terms of the inflation performance and what was going on? Anybody want to take a crack at that? I feel like a little
Well,
like
there wasn't a lot of inflation except around the War of 1812 and then the Civil War when we had to finance the wars. But overall inflation, wasn't it moderate?
It was all over the map.
It was chaos.
Oh, volatility was
Chaos.
high. Yeah, maybe average.
Lots of inflation, lots of deflation, lots of
Mhm.
inflation, lots of deflation. I mean, it was the business cycle, lots of business cycles. It was economic chaos.
Yeah,
I
the
think
wildcat banking era, right? Those
Yeah,
are just up, down, all around, right?
yeah. Well, so there was really no anchor to inflation at that time. It was really all over the place. And I think that goes to the lack of a central bank. I think that's a lesson of that period. And the U.S. government set up the first bank of the U.S. Soon after the Revolutionary War. That had a very short charter, and then there was a brief period before they set up the second Bank of the United States. I think that was early 1800s to like 1840, something like that. And it was kind of loosely managing monetary policy. I mean, it was issuing banknotes that were backed by gold, so they were relatively stable. But of course, this is where Andrew Jackson came in. He did not like the second bank because I think it's probably true. There was a bit of corruption there. The second bank would give credit and loans to curry favor to politicians and finance Jackson's opponents. And I think he took, as you would expect, umbrage to that. And when the charter for the second bank came up again, I think in the 1830s, he said he vetoed it. He didn't vote for it. And I think I think he won I think this actually helped him win the election of 1832 because he railed against, this is age old, right? Rail against the New York banks. In this case, it was a Philly bank. The Philadelphia bank the second bank was in Philadelphia.
And the building's still there.
Yeah, it's still there, right? I think it's a museum, right?
It is.
I've never been. Have you been to that museum?
I don't think so.
No, that sounds bad though.
Sounds awful as economists. We didn't go and visit there.
Yeah, we should really do that.
All right, field trip.
Maybe a field trip for the whole
Road trip for the podcast.
I'm sure people will appreciate that field trip.
We'll set up the podcast booth right there.
Yeah, exactly, exactly. But then I think we were completely rudderless without anything that approached a central bank through the Civil War, late 1800s into the early 1900s, and then we had the panic of 1907, and that was a doozy of a panic. And I think that has spooked people, and they said, we need, some stability here. We need a central bank. And so by 1913, they had set up the Federal Reserve. So I think the lesson from that period would be central banks play a key role in terms of inflation. Agreed? Disagree?
Yeah, well, I think you could take both approaches. Like central banks play, from some economists' perspective, a key role in keeping inflation low. Other economists have argued central banks are the root cause of inflation because they're just printing money.
You mean if inflation's too high, they do, yeah, I suppose. I mean, I guess this goes to crypto somehow, doesn't it? This goes to the we're talking about the Federal Reserve in the U.S. inflation, but certainly central banks overseas have shown less discipline, and as a result, have not had stable inflation, and that instability has created demands for alternatives like now crypto. So if you're like in El Salvador, the central bank of El Salvador is not, well, they dollarized, I guess, but that,
Yeah.
but I guess you're right. I think central banks are good and bad depending on where you sit, I suppose. Well, you would say, Ryan, though, that the Federal Reserve has done a good job, right? I mean, if you look at a chart of
Yes.
inflation or growth since the beginning of the country, you can clearly see
Mhm.
when the Federal Reserve was put in place, right? Before that, it was, as Chris said again, chaos, and after that, it's been a period of relative stability.
Yeah, I would agree with that.
Yeah. Okay. All right. Any other lessons from that period? Oh, the other lesson, I'm not sure if it's related to inflation, is that pay your debts. Alexander Hamilton decided early on that he was going to pay off the Revolutionary War debt, even though it was trading at pennies on the dollar at the time, because no one thought that the U.S. government would ever pay back the funds that they borrowed to finance the Revolutionary War. And the fact that he did that established the credit of the United States, the government, the central government. And we've been reaping benefits from that ever since. So another good lesson from that period, I think. Okay, let's move on. Second era, the Great Depression of the 1930s. How would you characterize that period? Anybody want to take a crack at that?
Chaos.
Chaos. Okay, all right.
Oh, you had deflation.
Different type of chaos. Yeah.
Yes.
Yeah. And why, when you say deflation, that means falling prices. And I think that-
Persistently declining.
falling prices. And I think they fell from the 1929 crash through the mid 1933, I believe they were deflating. Roosevelt came in early 1933, and he took the U.S. off the gold standard, and the economy reflated pretty quickly. So what's the lesson? Well, first let me ask you this: what's the problem with deflation? Why are people why such the fear of deflation? What's the economic rationale for why we don't want falling prices? I mean, if I'm a consumer, I kind of like falling prices, don't I? I mean, I can buy the same amount of stuff with less. So why what's the problem with deflation?
Yeah. Yeah. So yeah, sure. Falling prices are good, but the problem is that they keep falling, right? And there's a negative spiral that occurs, right? So if I think that prices are going to fall further, I'll keep delaying my spending, keep delaying my investment, because tomorrow I could get a better deal. And so the issue is, how do you break that psychology? It's really difficult. We don't actually have tools, or it's certainly not well understood, how to get out of that spiral without letting it come to its own natural fruition. And so it's dangerous from that perspective, right? On the other end, inflation, we actually have some tools. We know what to do. Been through some cycles. Might be painful. I'm not saying it's a good thing to go through an inflationary cycle, but on deflation, it's really unknown. It's hard to break that psychology, because it gets ingrained that tomorrow will be, everything will be cheaper tomorrow. So just to keep delaying.
Yeah, it's just economically debilitating.
Because
what Chris is talking about, the deflationary psychology. I mean, we can fast forward and talk about the housing bust after 2008. Deflationary psychology gripped the housing market. It took a long time to break that.
Right.
So people were delaying buying a home because they thought it was going to be cheaper next quarter, next year, 2 years from now. So you can see how that psychology feeds on itself and just becomes economically debilitating.
Right. So what you're saying is deflation and kind of depression go hand in hand. They're kind of intertwined and feed on each other. And therefore, if you're experiencing deflation, pretty good shot your economy's going to hell at the same time.
I always think of the 3 Ds of a depression. You have the depth, the duration, and deflation. All 3 of those are characteristic of a depression.
Yeah. I guess the other sort of reason, and this is kind of a corollary to what you said, is that if you're a debtor, that's a problem, right? Because the amount you owe that doesn't tend to go down. You got to pay that. No creditor is going to let you off the hook. You owe that money. But if you're in deflation, that means the prices for everything, including probably your wages or whatever your income source of income is, that's falling too. So you have, falling source of income to pay off your debt, and that's the prescription for default, right? I can't pay my debt, so I default, and that just exacerbates the economic problems. So the creditors who lent you that money, they have a problem. Those are obviously the banks and other creditors. They can't extend credit to anybody else, and everyone's going down into this deep, dark cycle, vicious cycle. That'd be, I guess, another way.
Yeah, that's precisely what happened with the housing market during the Great Depression, right?
Yeah, exactly.
People had these balloon payments, and there was no way they could pay them off.
I think the other lesson from that period, at least one of my takeaways, I'm curious what you think, is pegging your economy to gold is probably a bad idea. So it takes kind of monetary policy out of your hands and hard to react. And in fact, going back to the Depression, I think the British, they went off the gold standard first, and their economy reflated first. And then I think that's what Roosevelt saw. And then pretty soon after he got elected, I think almost immediately, I think he got into office early 1933, and he got off the gold standard. He had the bank holiday like immediately when he took office. And then I think in the summer of 1933, he took us off the gold standard, and that was the end of the deflation, or beginning of the end of the deflation. There was another bout of deflation later in the decade. We had kind of had a second, round of problems in the late 30s, not as brutish, not as a little bit more brief, but I think gold is certainly a fetter that. So that to me is a cautionary tale for anyone who wants to go back to anything consistent with the gold standard.
And the gold bugs haven't gone away. There's still some lawmakers still want to put us back on the gold standard.
Yeah, they need to read this history or listen to this podcast.
There you go.
Yeah, there you go.
Okay,
yeah, they keep coming back. I don't get it.
Yeah, I don't. Yeah,
it's every time the national debt keeps rising, so they're going to come back out of the woodwork soon.
Yeah, because they just don't trust that we won't see inflation. Yeah. Well, then the next period up, World War II, Korean War, we had pretty high inflation, kind of a negative supply shock, I guess, or I don't know how to. It's just a supply shock, right? Your economy, all the resources of your economy being diverted to building military equipment and financing the wars. So that means shortages for everything else. And demand generally is pretty strong because people are working, the economy is fully employed. That's obviously one of the key reasons why we got out of the 1930s depression, deflation, because we had this huge, massive influx of government spending to fight the war. But that was a period of rationing, supply shortages, generally higher prices. Not consistently, but generally. I'm not sure what lessons to take from that other than, well, the good thing is it got us out of the depression. The bad thing is, obviously people had to live with rationing and everything else. So that wasn't a great time.
A lot of people drawing parallels of what's going on today to after the Korean War and World War II, right? because of the supply shock. And they're kind of pointing to that to show that it is transitory. It's temporary.
Oh, interesting. Really?
Mm-hmm.
Well, I don't know that history very well. In the Korean War, did we have shortages? Were there a lot of shortages? I suppose there was, but I don't remember. I don't know that history very well.
Neither do I.
Yeah.
Interesting. But I know we had shortages around World War II.
Yeah, then we
for
did.
sure.
Yeah, for sure.
Mm-hmm.
Yeah.
But so that's the event you're pointing to, I guess.
Yeah, and also people are pointing to after the Korean War, so I assume there were some shortages. I just don't know I haven't looked at it.
Yeah, I don't know that history as well. Yeah. Well, it's interesting. The Korean War, I mean, there was a lot of American troops overseas for fighting that war. It's shocking. You look at, the percent of the labor force that was overseas, it was very high. People kind of not focus on Korean War, but that was a pretty all-encompassing war for us. We were pretty, much of our economy was wrapped up in that war. So very important. Okay, here's the fourth era of inflation. So we're now up to the mid-60s. I call it the Great Inflation, and I don't think people recognize, but inflation started to really take off in the second half of the 1960s, and then went stratospheric in the 70s and peaked in the early 80s. I believe CPI, consumer price inflation, peaked at close to 15%, I believe, in the early 1980s before Paul Walker kind of stepped in. So I've got a few takeaways from that period that I think are good lessons. What are yours? Anything you would point to that are lessons coming that are helpful in thinking about inflation?
Certainly a lot of lessons for macroeconomics, right? All the models broke down and didn't contemplate these types of oil price shocks, reliance on the Phillips curve and whatnot. So certainly there were a lot of lessons learned, or hopefully they were learned. It seems like
maybe this is a good time to explain to the listener the Phillips curve, because we'll come back to that.
Now we're getting into the Phillips curve already.
Well, just because Cris brought it up, so people are asking the Phillips curve. If you're not an economist, you may not know what that is. What is the Phillips curve?
So it's a relationship between unemployment and inflation. So there's a trade-off between the two, or I guess there's a presumed trade-off. Or prior to the early mid 60s, there was a quite strong trade-off. But then over time, things have broken down a bit, and the theory has been revived in various fashions. Had to tinker around short-term versus long-term Phillips curve. So there's a lot of debate whether this relationship actually exists anymore between the two, or if it takes so many heroic assumptions to maintain.
I think it still exists. I just think the relationship is much weaker than it was in the 60s and 70s.
Yeah. Okay. Fair enough.
Yeah,
more dynamic, I guess.
Exactly.
Or the measurement is also questionable. Like, how should you be measuring slack? Is it truly unemployment? Is it employment population ratio? What's the right measurement?
Prime age, Chris.
But we'll come back to this in the context of our discussion about what's going on now. But my sense is the Phillips curve, that relationship between unemployment and inflation, is what I would call very non-linear. There isn't much of a relationship until unemployment gets to a certain point, and at that point, things change very quickly. Wage and price pressures, develop very rapidly. So nothing yet. You're at 6% unemployment, obviously no problem. 5% unemployment, no problem. 4% unemployment, no problem. 3.5% unemployment, nothing really. 3%, boom, you got a problem. So you kind of hit some kind of tipping point in labor markets and psychology, and you're off and running. So it feels very, very nonlinear to me. But
the other two lessons from that period is, with regards to the Fed, is don't let inflation get out of control, or it's really, really painful to tame inflation. And then,
well, what does that mean to get out of control?
Like consistently above their target. I mean, I think
why?
Because it dislodges inflation expectations.
There you go. Inflation expectations, right? That's the key.
Yeah, that's the key.
Yeah.
That's the lesson from the 60s and 70s. And
okay, so what is inflation expectations?
So it's people, I mean, there's all different measures of inflation expectations, but it's basically what people or businesses anticipate inflation to be 1 year from now, 5 years from now, 10 years from now.
Right. So in that period, inflation expectations rose, and that's what you meant when you said the Federal Reserve lost control.
Correct.
And that's, at that point, it's very difficult to get those expectations and thus overall actual inflation back down.
Yeah, to get them back down, Volcker, who was chairman of the Federal Reserve, had to jack up interest rates very, very quickly, get them very high to bring realized inflation and inflation expectations back down.
Yeah. Okay, here's my historical narrative of that period. So you go back into the mid-60s, late 60s, that was the period of Vietnam and of the Great Society. So Lyndon Johnson, the president, ran a what they call highly expansionary fiscal policy. That is, I'm going to spend a lot of government money, it's kind of sort of the debate we're having now around inflation. Deficit financed, I borrow money to do it. And at that point, the economy coming into that period was pretty close to full employment. Unemployment was very low. The Phillips curve was working fine, but he really pushed on the accelerator, and the economy started to overheat. Then you get into the early 70s, and all of a sudden you have oil price shocks. That's the oil embargoes. There was one in 73, I believe, and of course another one in 1980. And that was a very significant supply shock. It hurt growth, but it really jacked up inflation. At that time, the economy is very dependent on energy. We consumed much more energy than we produced, so that really, jacked up inflation. And then that's when inflation expectations come in. The Fed decided, oh, I'm going to focus on the weaker growth created by the higher oil prices. That's, the negatives of that, and not focus on inflation. And therefore, they kept interest rates very low for a long period of time. Let those higher inflation expectations become entrenched, and then you're in this vicious wage price spiral where, you know, everyone thinks inflation is going to be high, so workers demand a higher pay increase. Businesses say, fine, no problem. I'll give you that pay increase because they know they can pass that through to their customer in the form of higher price. Workers see that. They say, okay, you got to pay me more. You got to raise my wages even faster. And you can see how you get into this kind of very dark wage price spiral. This dynamic I just described sounds kind of familiar, doesn't it? Sort of, right? Around the pandemic.
Mhm.
Same kind of dynamics. And people are arguing the same kind of dynamic. I don't believe it to be the case, and we'll come back to that in a few minutes. But, that's when people worry about inflation today, many of them are hearkening back to that period of great inflation in the late 60s, all the way going up into the 1980s, right?
I mean, that's why
So-
people are talking about stagflation, because that's the last time we had a
Yeah.
period of stagflation, which is
Yeah.
very high inflation and low growth or high unemployment. And that's a central bank's worst nightmare, like you were discussing. Like, do you focus on inflation or do you try to stimulate the economy? You can't, win both.
Yeah, of course. Now, the nice thing about that we learn from that period that we're using now, and the Fed is using now, is that inflation expectations matter. So back then, inflation expectations rose. Well, back then, no one was even talking about inflation expectations. That wasn't even on the kind of the nomenclature. They weren't even thinking about it, and so they had no way of measuring it, and they had no way of thinking about it, and they didn't respond to it. But today, we know inflation expectations matter a lot, and so because they're stable and low, the Fed's saying, hey, I still feel comfortable that inflation is going to come back in. I should be focused on the negative shock created by the pandemic, the ill effects on the labor market, the fact that unemployment and underemployment are still relatively high. So the difference between now and then, big difference between now and then, there's many, but the big one is inflation expectations. Just even focusing on them is a big difference, but measuring them and then basing policy on them are also a big difference. Okay. Then we, of course, as you pointed out, Paul Volcker, who became chair of the Federal Reserve in the late 70s, figured out that the only way that they're going to wring out these inflation expectations, bring inflation down, was just to kill the economy. And so he jacked up interest rates. They went into double digits. Mortgage rates were 15, 20% back in the early 80s, did a number on the economy that kind of wrung out inflation expectations. Not completely. Alan Greenspan, the chair of the Fed who took over from Volcker in the 80s, had to do more work and keep interest rates relatively high to further wring out inflation expectations. But Paul Volcker did all the heavy lifting during that period. Yep. And that got us into the early 90s and mid 90s. And this is a period of relatively low and stable inflation. I call this the period of the Great Moderation, from 1990 through 2010. And here we benefited from a positive supply shock, right? Right? That was a period of the technology booming.
Yeah.
That's when we had IT, right? So we had a positive supply shock. It was, the internet came on, generated a lot of economic activity, increased the productive capability and the size of the economy, which took the pressure off inflation. So this is a period of very strong growth and relatively low and stable inflation. So it was a kind of a nirvana period that took us into the early 2000s. Was there any lessons from that period that you would take away from that period?
I don't know about lesson, but I would throw trade in there as well, right? This was a period of trade liberalization, right? We had NAFTA, we had lots of trade deals around the globe, and presumably that helped to contain the costs as well.
Of course, China entered into the WTO in 2001, and that really changed a lot, right? That really brought down goods prices because a lot of goods manufacturing globally got pushed into China where the costs were lower. And that brought down goods price inflation. That's a good point. That's a very good point. So you had a technology boom, and you had this increase in globalization. I guess deregulation might have also played a bit of a role, right? Wouldn't you think? In terms of, you go back to, guess the seminal event was when, I guess this is kind of anti-union, when Reagan broke the air traffic controllers union back in I think it was 1980, or the early 80s, and you had a period of deregulation in lots of different industries. That also, I think, affected labor's negotiating power, helped to reduce inflation expectations, and also caused prices in different sectors to at least the rate of growth slow or even decline in some sectors. So that might have played a bit of a role then too. I think a lot of reasons for that, but for that slowing and moderation in inflation, but regulation might play a role kind of on the list, towards the bottom of the list.
I'm just throwing this out there. Do you think income inequality or wealth inequality over that period played a role in keeping inflation low?
How so?
You just get the distribution of income skewed away from people that have a high marginal propensity to consume towards those that have a high marginal propensity to save. I'm just throwing it out there because that's another thing that occurred in the 1990s and early 2000s.
I think that was certainly a result of all this, the globalization, the deregulation, the technology,
the decline in the unions.
Declining unions all played a role in the skewing of the income and wealth distribution. But I don't know. Can you connect the dots back to inflation? At least directly connect the dots.
Not directly, but maybe through like income wage growth, things like that.
Yeah. I don't know, Chris. What do you think?
I think the causality naturally. I think the causality goes the other way, but right, those other factors caused inequality, but inequality leading to lower inflation.
I don't know.
It's
a stretch.
I will say one other key takeaway. Oh,
okay.
Go ahead.
No, go ahead.
Just looking through the whole list here, or as we're talking through this, psychology is such a large component of this, right? Really, if you want to be a student of inflation, it sounds like you have to be an armchair psychologist to really understand what's going on. And I think the Great Moderation, right? You also had a period of, fiscal discipline. I think people felt pretty comfortable that during that period that inflation was not going to take off or deflation was not going to creep in. So I wonder if that also played a role here. Just that consumer psychology was pretty stable during that period. Yeah.
I think you're right. Sentiment, psychology, which I wrap up into expectations. Yeah, I think they're very critical. I guess the other, going back to the technology boom, that was a period of pretty rapidly declining prices. Remember, there was outright deflation for chips and other technology, internet technology, and that I'm sure had a role in bringing down inflation in a very significant way. Yeah. So
well, on that note, another issue here is measurement throughout this whole period as well. When we are measuring inflation as well, so that's another issue just in terms of the whole discussion here is how can you measure prices over time and how do you do that consistently? How do you account for those quality changes? So just a little grain of, I think we've got all the arrows right, but a little grain of salt that how we're measuring inflation.
So what are you referring to when you talk about the technology boom and measurement? What are you referring to?
So inflation overall is a measurement of general price levels over time. How do you control for changes in the quality of the goods over time is a really challenging technical issue, right? We're not just talking about apples in one period versus apples in another period. We're talking about Apple computers in one period versus Apple computers in another period, which have a very different set of capabilities, right? So if you just look at the list price of those two goods or those two computers, let's say, right, they might be the same, but one is substantially more powerful. So how do you control for those changes in quality over time? And that's something that the BLS has struggled with. I think any economist struggles with to make those types of quality measurements. So when we're looking at some of those inflation figures during a period of rapid technological change, it could be difficult to really grasp the true underlying price changes.
On a similar note,
go ahead, Ryan.
In that period, the Fed shifted their focus from the consumer price index to the personal consumption expenditure deflator. So they're essentially measuring the same thing, consumer prices, but they have different methodologies, they have different weightings. One uses fixed weights, which is the CPI, and Greenspan argued, I think it was in the mid 1990s, that the CPI was overstating inflation. So that change going away from the CPI to the PCE deflator doesn't seem to make a big difference, but it does today. And next year, it's going to be really important. And we can talk about that down the road.
Yeah, yeah, good point. Just to strike the point home, though, for the listener, uh, the Bureau of Labor Statistics, which is the keeper of the CPI data, the Consumer Price Inflation data, and I guess it's the Bureau of Economic Analysis who uses the CPI and the producer price indices from the BLS to construct the core PCE. They do make quality adjustments. You're just saying that's pretty tough to do in any time, but particularly in a period of rapid technological change, because things are improving, quote unquote, and measuring that's pretty tough to do. That's what you're saying.
That's right. That's right.
Yeah.
Yeah. I have a lot of respect for the work they do. Certainly, it's just very difficult to disentangle.
Right. Okay, this brings us up to the last historical era, inflation era, and that's the period of low inflation, disinflation, which is decelerating price growth. So there was some about the deflation concerns, and this was after the financial crisis in the last decade before the pandemic. And it's weird to think about it now, but just before the pandemic hit, the Federal Reserve was and every central bank in the developed world was struggling with how low inflation was. It was just consistently below their targets, and they were trying to get it up. And so what's the lesson learned from that period of, let's call it low inflation period? I mean, what caused that? And, what's the lesson from that period? Any views on that?
Well, we had a very, very slow recovery after the financial crisis, which, the catalyst of a recession can also factor into the strength of the recovery. And when you have a financial crisis, usually the recoveries are much slower. So I think that's one reason why central banks were struggling to get inflation higher.
Yeah.
We saw a lot of slack in the labor market. I mean, we didn't get a lot of improvement in the job market for years.
This gets back to sort of the Phillips curve, right? I mean, what you're arguing is that you came out of the financial crisis, the economy grew very slowly, didn't absorb all the slack. Unemployment was high, or other measures of slack in the labor market signal a lot of excess capacity there. People weren't working. That kept wages down and prices down. That's one reason why I had low inflation. Of course, China and globalization were still playing a key role there, keeping inflation down. Inflation expectations, they were starting to migrate lower. They held in pretty well, though, and that's one reason why we never experienced outright deflation, because people still believed at the end of the day the Federal Reserve and other central banks would get what they wanted. So inflation expectations held firm. But that was a period when it was, and I think we came to the conclusion that one that you mentioned earlier, Cris, that we have pretty good tools for bringing down inflation. We don't have really great tools for bringing inflation up, or certainly for in a deflationary environment, ending a deflationary period. So that's another lesson, I think, from that period. And the Europeans, I don't know, they're in Japanese. I'm not so sure that, I think we all kind of feel we're broken free of the low inflation period. I think we feel that way at the moment. I'm not sure if that's how the Europeans and Japanese think. I'm very curious.
Well, the other lesson is don't flinch when you see inflation for the first time for central banks. I mean, that's what the Fed did. They were very, very patient, waiting for inflation to accelerate. Other central banks, as soon as they saw, the white of inflation's eyes, they panicked and they started raising interest rates, and then their economies backtracked.
Right. This is coming out of the financial crisis, you're saying.
Correct.
The Fed waited, and inflation, even though it was low here in the U.S., it was much stronger than it was in Europe and Japan, particularly Europe, where they kind of reacted immediately to the high inflation, kind of cut off the growth, and never got back to a place where they felt good about inflation.
Yeah, and I think the other lesson during that period is that our economy is much less sensitive or reliant on energy prices. So in the past, go back to the 70s and 80s, we talked about it, that led to a lot of higher inflation, persistently higher inflation. Now, fluctuations in energy prices have a very temporary impact on consumer prices.
Right. Hey, one other quick thing before we get to inflation in the current context. Why 2%? Why does the Federal Reserve Board have a 2% inflation target? I got my explanation. I'd be curious to hear what your explanation is. Why 2? Why not 1.56897 or 3.4582? Why 2%?
You want to go first, Cris?
Oh, go ahead. So I guess we're asserting, everyone agrees that it should be greater than zero should be some positive number, right? Right, because zero is too close to the bound. Deflation, we already established that. But why 2 versus 3?
Yeah.
That's
or 4.
I don't have a strong opinion on that. I think if
I
you
don't think
choose something,
Yeah, I don't think there's a lot of rationale. I mean, 2% is the golden rule for most central banks in developed economies, is that they aim for 2% inflation because it's far enough above zero where you don't worry about deflation, and also it's far enough above zero where if you get these measurement issues that you're actually not targeting too low of inflation.
I'll give you 2 reasons. One, substantive reasons. One, if you're at 2, that means some industries, some businesses are pretty close to zero. And it's not a great thing if any business or industry is experiencing outright deflation, right? For the reasons we articulated before. So you want inflation set high enough that no industry or business of consequence is in a deflationary environment. I think that's part of it. Second is, if you have 2%, it's high enough that you have the Federal Reserve and other central banks have a little room to lower. You have low inflation, you have low interest rates. If it's too low, you have no room to maneuver. And this is, if it was 1%, if you set it at 1%, then the Fed interest rates are going to be very low through even the best of times. Yeah. And the Fed doesn't have a lot of room to react when things are tough. And that's why there's a move afoot, or at least there's been a lot of debate that maybe 2 is too low. Maybe it should be 3, because if it's 3, that means the growth in the economy is strong enough in the good times and interest rates are high enough in the good times that when the bad times come, when you have a recession, you have enough room to lower rates and don't hit the zero lower bound and have to engage in things like quantitative easing, bond buying, and that kind of stuff. So I think there are some pretty good reasons why you'd want to keep inflation around 2%.
I think there's also lots of discussion around whether the 2% target has been interpreted as a ceiling or as a median. So far, or previously, it had been really the market ceiling, right? So you go to 2.5 to get 2, right? I think that's
if it's 2 now I think, correct me if I'm wrong, Ryan, because you follow the Fed closely. I think they changed the monetary framework back in last summer, and they said, okay, it's not 2%. It's not the ceiling. 2% is kind of through the cycle.
Right.
If you're below 2 for some points of time, you have to be above 2 for some point of time, so that on average through the business cycle you're 2. Which if you think about inflation expectations for a second, if you don't do that, if 2% is your ceiling, inflation expectations will always be below 2, which means you'll never get to 2. So and that's simple arithmetic, I think. If you kind of think about it. Anyway, okay, all right, we're real time. We're talking about, inflation today, and obviously inflation is up a lot. The consumer price index is up 6% plus year over year, the highest in over 30 years. And, there's a lot of debate and discussion around this. We debated it on our last podcast a little bit. Maybe we should reprise that and, see where people stand. So just to summarize kind of the broader theories around inflation and inflation dynamics, we began with the pre-Fed period. That goes to the theory of the monetary theory of inflation, that what the Fed does ultimately determines inflation, which I think is the case. But the view here is that the Fed controls the money supply, and the money supply ultimately controls the rate of inflation. We talked about the Phillips curve. The relationship between unemployment and inflation as another kind of way of thinking about inflation. We've talked about supply shocks. We've talked about negative supply shocks, oil price increases, positive supply shocks, a technology boom. Of course, the pandemic is a negative supply shock. Of course, we talked about inflation expectations. These are all, key elements about how people are thinking about inflation dynamics today. So, you add it all up, and we're sitting here today. The key question is, and it's the question everyone's asking, is this 6% inflation temporary? So the first question I have for you is, well, what does temporary mean? Or the Fed in Fed nomenclature, transitory, another way of saying temporary. What does that mean to you, temporary, transitory?
All right, well, I'll go. I mean, Cris is checking his notes.
Yeah.
I thought you were all over this one.
Oh, no, I wanted to look,
Go ahead.
There's no time element to transitory. So you don't want to say it's 6 months, 8 months, 12 months. It's whether or not the underlying fundamentals are going to support persistently high inflation, and that is just not going to happen.
Chris, do you have a definition of temporary transitory?
Um, I think Ryan's is a good one, but I would throw the acceleration element, kind of that second derivative in there, right? If you see that the inflation rate is still high but is falling, right? I view that it's going towards that 2.25% target. That, to my mind, indicates something that's transitory. If it's accelerating or if it's maintaining, right, then that's more of a permanent effect.
Well, in the current context, the first derivative is certainly positive. That's the rate of change is positive. And the second derivative, which is the rate of change, is also positive. It's accelerating. So that would not be consistent with the idea that it's transitory, temporary by your definition.
Well, it's
so for the next quarter, right?
Yeah, exactly. Next year, that second derivative.
Oh, but I want a definition that is functional, that helps me. I mean, so you're saying. So what are you saying?
It comes back down to psychology. Then I guess it's the belief that the rate of change is going to decline over time.
Okay, that's the answer in my view.
Okay,
it's inflation expectations. If inflation expectations are low, people believe inflation is going to come back down, then it's transitory. It's going to be transitory. They're going to come back down. It's just a matter of time. It may take a little. It may not be next month, the next quarter. But expectations are rising. That's no longer transitory. That means we're not going back to where we were. Right? Make sense?
Yeah, I think we're in the same spot. Yeah,
same spot. Okay.
And people believe it's transitory because of what we're going through. You have supply chain shocks. They know that that's going to get wrung out, and that will be disinflationary next year.
Right. Okay. So there's a few theories of what's going on here that have important implications. One in terms of inflation and whether it's by the way, I'll say it unequivocally. I think this inflation is temporary, transitory. That by this time next year, inflation will be, it may not be all the way back to the Fed's target, but to your point, Chris, second derivative, it will be decelerating to the point that I don't think we're going to be really talking about inflation. Certainly not in the public discourse. Economists will be, but no one else will be. Are you guys on board with that? Anyone disagree with that perspective? Or you're both on board with that?
Yeah,
I'm on board.
I think it could be even faster.
Okay, and maybe this is a good time to reprise our debate, which we had in a podcast early on. Early on was like our second, third podcast, back in the spring of this year, and we, correct me if I'm wrong, if I've characterized this wrong, we were focused on consumer price inflation, and I said in our forecast was it for it to settle back into around the mid 2%, 2.25%, 2.5%, something like that. That's our baseline, and still is. And I was saying, and that's where you landed, Chris. You said that's where we're gonna go back to 2.25%, 2.5%. I was saying no, it's probably going to end up being higher than that, probably north of 2.5%.
You were closer to 3.
3, but I didn't think it was going to land there forever at 3. I mean, that was kind of sort of where we're headed, 2.5 to 3, and you were like less than 2.25. You were like 2, maybe 1 3/4 to 2.25, something like that, right, Ryan?
Hey, Chris was 2 to 2.25, right?
Yeah, I think so.
Ben's got it written. Yeah, I think that's what.
So was it? Well, no, wait.
I was
that number 2.25. Yeah.
Was that core? So that we were looking at the core consumer expenditure deflator then. Okay, fine, all right.
Mm-hmm.
So in terms of the core consumer expenditure deflator, it was 2 to 2.25 for Chris. I was 2.5. 2. I don't think I was at 3 for the core consumer expenditure deflator. I was north of that. You were south of that. So I know we're getting bogged down on the numbers, but bottom line. Is everyone still happy with where they're forecasting inflation to go?
No.
You're okay. So where are you now, Ryan? By the way, I'm very happy with where I am. I'm assuming Chris is happy with where he is. Yeah. Chris is happy.
Remember the bet was average over the next 5 years.
I don't remember that part.
Okay, I don't remember that.
We got to check the tape. I thought we were talking about average.
Okay. Well, anyway,
Ben.
So, okay. All right. So what are you saying then? Are you happy? You're not happy with your forecast?
No, because I think
okay.
Getting back to the psychology and inflation expectations, they're going to get pinned where the Fed wants them to be, and that's a little bit above 2. So I think that's where we're going be closer to what Cris is saying.
Oh, you know what? This is very crafty on Ryan's part.
How's this crafty?
Very nuanced. What he's saying is, I wasn't wrong.
Mhm.
What happened here was
was wrong.
the Fed changed its framework of monetary
did.
policy. Therefore, I'm changing my forecast. Like kind of Keynes.
When the facts change, you got to change your opinion. So
That's very creative, very good of you.
Mhm.
That's a
You're
great
wrong,
quote,
but-
Warren.
Yeah, that's interesing. Good point, though. That's a really good point.
Mhm.
Okay, so here
Oh,
we're
wait.
what?
But your right, your argument, as I recall, was demographics. You
It
were
was
arguing.
demographic. It
It is
wasn't the Fed.
demographic.
He was right he's changing
Aging-
his view, but he was,
Well, that's okay. The Fed is certainly part of that argument,
Yeah.
but
Mhm.
I wonder if his demographic outlook has changed at all. Is that no?
Nope.
Okay.
you
So
still think that's a big deal.
And I think productivity is going to be a lot stronger than people think. And that, as we talked on the past podcast, that's the firewall between a strong economy
Oh.
and inflation.
Right. You got to be positive again. This positive supply shock lifting, and what's that? Work from anywhere? Kind of supply shock.
Work from anywhere. Businesses, during the pandemic, invested a ton in equipment and software. So I think
Right.
productivity is going to be stronger than it was, very much stronger than it was pre-pandemic.
Yeah, so that's a supply shock argument
Mhm.
Mhm.
that we're going to get we're getting a positive supply shock, which is kind of first. The pandemic initially is a negative supply shock, but we are going to get some positives out of this on the other side of it. Yeah, interesting.
Yeah, I think to your
Uh,
point, we're not going to be talking about inflation, this time next year. It's going to be heading back towards the Fed's target, and then we're going to undershoot. So we're going to fall below 2% for a period of time,
Right.
and then come back up.
Okay. So our collective view, and I make mischaracterize this, and just correct me if I'm wrong, but what we're saying is the pandemic is a negative supply shock. It obviously hurt growth and is causing inflation to rise, but it's not going to be permanent or persistent because inflation expectations remain well anchored. And moreover, a lot of the inflation is related due to the effects of the pandemic, and as the pandemic fades, supply chains, labor market issues will iron themselves out, and inflation will moderate and come back in. And where it actually lands, give or take, or we're debating whether it's a little higher than the Fed's target or the Fed's target a little bit below. But we're all still saying
pretty narrow.
basically that inflation is going to get back down to something we all feel comfortable with that we're not going to be talking about. Is that a fair characterization?
Yep. Yeah, that's right.
Let me try one other thing out on you, because this is another kind of strain of thought in the current debate and discussion around inflation. And that is that fiscal policy is the cause of the higher inflation. That the American Rescue Plan, we've had a lot of fiscal support during the pandemic, beginning with the CARES Act back in March of last year, extending through the American Rescue Plan March of this year, $5 trillion in total, 25% of GDP. That is the cause of this higher inflation. What do you think of that argument? You didn't bring it up, so I don't think it's on the top of your list, but do you think this is playing much of a role here, or any of a role, or having any impact whatsoever?
I think it's having a little bit of an impact. I think it
little
helped exacerbate the supply chain issues because those economic payments, I think they should have been spread out over a period of time. There was just too much money going into people's pockets. Then good spending went through the roof, and that exacerbated the supply chain problems that we have today.
Chris?
Yeah, I'd buy that. Some effect, but I would say actually pretty
Small.
minor. Pretty minor. Yeah.
I can't connect the dots, to tell you the truth. I mean, the ARP, the American Rescue Plan, really juiced things up when we needed it back in March of this year, into April, maybe into May, before the Delta variant of the pandemic hit. By the time the Delta variant of the pandemic hit, which was, beginning in June, really in July, August into September, the American Rescue Plan had turned into, it wasn't a supportive growth. It was actually turning contractionary. It really wasn't providing much support whatsoever. The bulk of the stimulus from that was back in the spring. By the summer, that stimulus was largely gone and fading pretty quickly. And right now, it's turning into a bit of a headwind to economic growth. The other thing is that demand, sort of the channel through which the ARP, the American Rescue Plan, the fiscal support would influence inflation is through demand, right? You're saying fiscal support government spending, tax breaks, demand. Demand means inflation, but demand growth got hit hard in the summer. Demand growth came to a standstill, because of the Delta variant. So it's hard for me in terms of the timing of all of this, and even kind of the intuition behind it, that you can connect those dots. I just don't see it playing a role of any consequence here.
Well, what about this argument? You get the economic stimulus payments, a lot of demand, reduced inventories, and then when the summer came, Delta variant hit, supply chains got worse. There's shortages of things that drove the prices of those things higher.
Yeah, I think that's a real stretch. I think supply chains were getting back online. Or, there were still problems. Labor markets were still a bit scrambled, but they were getting back to normal. And then the Delta hit, and just exacerbated everything, re-scrambled everything. So I don't know. I think that's a pretty weak thread. Yeah, which actually is important because the Build Back Better agenda, which is being debated now in Congress, people say that's going to be inflationary. Which I don't know. That's certainly not what's going on now. Is anything related to what's going on with Build Back Better? Anyway, we're running out of time, and I promise that we keep this to the time. So I'm going to stop right there unless there's anything else you wanted to add. I thought that was a pretty good history lesson. What do you think? Should we do this again? Yeah. I mean, I think
sure.
the final point here I'd make is we got to be, and I've said this a few times on these podcasts about different things and maybe about inflation, but we got to be humble about this, because inflation is everything economic is complex, but inflation is particularly complex phenomena, because Cris keeps pointing out, it's also related on psychology and sentiment, which, very difficult to measure, very difficult to gauge. And so we've got to be humble here in terms of our understanding. It's rather limited, and makes this a particularly uncertain period going forward.
Well, I'd say we have to be humble, certainly, but we also have to learn
lessons.
Humble?
Did I say humble?
You did say humble. Yeah. I'm agreeing with you.
Okay.
We have to be humble, but we also have to learn the lessons from the past, right? So, like the gold standard, right? That really, we should be putting that. We shouldn't be spending any more energy on that topic and focusing on the future. But
agreed.
There we are.
Right, and also that the money supply causes inflation. That used to, but that's no longer the case.
Yeah.
So you got to learn that these relationships, we talked about the Phillips curve,
Yeah.
M2, money supply growth, those relationships change over time. So you don't want to get wedded to your models.
Totally.
The long run M2, right? You're on board with that, right?
Yeah, longer, yeah, but not now.
All right. Well, with that, Ryan, I'm looking forward to the field trip to the Second Bank of the United States. So
I like this field trip idea.
We got to get going. We're going to call this a podcast. Hopefully you have a wonderful Thanksgiving, and we'll see you on the other side. Take care now. Bye-bye.